One real estate investment trust that has really started to garner quite a bit more attention over the past few years and has even been dubbed the younger brother of Realty Income, stock ticker O, is Agree Realty Corporation, stock ticker ADC, trading at $76.88. And look at just the last month, they're up about 7%. And if we look at the last year, they're up about 39.2%, which doesn't even include that high starting dividend yield that this REIT has. And if we just quickly glance at the rating summary from Seeking Alpha Analysts, Wall Street, and the Quant, we can see people are actually quite bullish on this REIT, even after the recent run-up in its share price. So in this video, let's talk about this REIT, why people like it so much, talk about its growth potential, and of course, look at the valuation. Now, like I said earlier, people have dubbed this REIT the younger brother of Realty Income. And if we look at the difference in size between these two REITs, we can see Realty Income has an enterprise value of close to $76 billion, while Agree Realty Corporation is only about $10.77 billion. So Agree Realty is obviously quite a bit smaller than Realty Income. Now, we're starting to see more and more investors claim this is an advantage for ADC and a disadvantage for O, and it's pretty clear why. Because Realty Income is so large, its acquisition volume has often been larger than the entire market cap of many of its smaller net lease REIT peers. So in order to grow at a high rate, people are afraid Realty Income will have to reach outside of its circle of competence in order to find investment opportunities. So there's really two main risks. In seeking to ramp up its investment volume, Realty Income may have to lower its underwriting standards and make lower quality investments. And when we talk about real estate investment trusts, we have to remember, a REIT is only as good as the tenants in its portfolio because obviously tenants are the ones paying rent. Then we have the market may value O at a discount as it becomes more diversified, because a lot of the times we see diversified REITs tend to trade at a discount to the sum of the parts value. So this is why a lot of people who have really been bullish on Realty Income for years now are actually starting to favor Agree Realty Corporation. Now, if we go ahead and jump over to the dividend breakdown sheet, let's take a look at those dividend metrics for ADC. Now, what we can see is for ADC, that starting dividend yield is currently sitting close to around 4%. And one of the things we have to keep in mind is that dividend yield has certainly been lowered by the massive run-up in the share price we've seen over the past year. So to put things into context, if we look at that starting dividend yield over the past year, we can see at one point it was above 5%. So this started to go lower as the share price went higher. Now, one of the other things we have to keep in mind is this is a REIT that actually switched to paying monthly dividends back in 2021. So they used to pay out dividends on a quarterly basis and then switched to monthly dividends, which I know gets a lot of dividend investors excited. But what's also great is dividend growth has actually been quite good, especially for a real estate investment trust. Look at the 5-year dividend CAGR, around 5.7%, the 10-year, around 5.6%. Again, that's pretty good dividend growth for a real estate investment trust. Now, Agree Realty recently released their latest quarter's earnings around a month ago, and there's a couple of things that we do need to point out, something that is actually quite good news. Now, if we take a close look right here, we can see adjusted funds from operation on a per share basis increased by about 4.7% for Agree Realty. Now, adjusted funds from operation is perhaps one of the most important metrics that we need to look at when we're talking about a real estate investment trust. It's kind of like earnings per share for a REIT. But it's important we don't just look at adjusted funds from operation, we have to look at it on a per share basis, especially when we're talking about REITs, because we have to remember REITs will pretty frequently dilute their shareholders in order to grow. In fact, if we come up here and plug in ADC, all this data will load in. And again, like always, you can download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet by going over to tickerdata.com. But if we look down here on shares outstanding, we can see every year they're diluting shareholders. And this is typically a red flag for most businesses, but it's pretty common for REITs because it's one of the ways for them to raise capital in order to make more acquisitions. Because remember, REITs are required by law to pay out 90% of their earnings in the form of dividends. So we have to put this into context. But going back to AFFO, this is the reason we have to look at it on a per share basis. It's not good enough for a REIT just to grow adjusted funds from operations. It has to grow on a per share basis, and we can see they did pretty good at about 4.7%. That's typically on the upper end that you'll see for most REITs. So this is a REIT that's growing a little bit faster than their peers, such as Realty Income or NNN. In fact, if we put into comparison, we can see they grew at about 4.8% year over year from 2023, while one of their competitors, NNN, only saw a 2.8% increase, so again, growing faster than their competitors. But now we need to talk about one of the main reasons people like Agree Realty. And really it boils down to two things. The management team of this REIT has done a great job avoiding some of the headwinds that a lot of REITs have really struggled with over the past decade. And this started back in 2010 when they launched an acquisition platform with a focus on e-commerce resistance. Obviously, that was pretty good foresight. On top of this, they avoided or actively disposed of troubled retail sectors including theaters, pharmacy, health, fitness, and entertainment retail pre-pandemic. And as we know, these are the exact type of properties that really struggled during the pandemic. So that was great foresight and should give you some confidence in management. Add on to this, if we jump over to the 12th slide, Walgreens, obviously a company that's been struggling quite a bit, but the point we want to make in regards to Agree Realty is ADC actually reduced Walgreens exposure from 30% in 2012 to approximately just 1%. Again, this was phenomenal foresight by the management team. So this is point number one that should give you confidence. Now, if we go ahead and jump back over to the 16th slide, let's talk about what's perhaps most people's favorite thing about this REIT. Most people love this REIT for the quality of their tenants. We can see very familiar names like Walmart, Tractor Supply, Dollar General. We have Lowe's, Dollar Tree, Kroger. If we take a closer look at their top sectors, we can see grocery stores and home improvement about 9.2% each for the total portfolio. Tire and auto service about 8.1%. Convenience stores 7.5%. And at the very bottom, we have consumer electronics at about 4%. So just how good are these tenants? Well, let's put it into perspective. If we look right here, we can see 68% of their tenants are considered investment grade. To put that into even more perspective, we can see again ADC around 68 to 69% tenants are investment grade, while Realty Income is sitting at 35%. So the quality of tenants for ADC is significantly better than Realty Income. So what has ADC been investing in lately? And really they focus on 4 core principles when they look at opportunities. 1, they're looking for e-commerce resistance, they're looking for recession resilience, avoidance of private equity sponsorship, and then strong real estate fundamentals and fungible buildings. And clearly this has been working for them in the past because their growth rates have been quite a bit higher than their peers. But what about forward looking? Well, if we look at the 36th slide on this presentation, we can see 2025 guidance is telling us about $4.26 to $4.30 in AFFO per share, which would probably be close to around 4% growth. So again, we can start to see why people like this REIT so much. It still has a pretty solid growth runway ahead of them, has solid tenants, and a good history of delivering large monthly dividend payments that are growing at a pretty decent rate on an annual basis. But what about this valuation? Is it too late, trading at $76.88? Well, to answer that question, let's go ahead and jump over to my REIT valuation spreadsheet and plug in ADC. Now, the first valuation we're going to look at is going to be our AFFO multiples, but in reality, this isn't going to paint a perfect picture because ADC is growing faster than these other REITs, which obviously warrants a higher multiple. But if we look at these comparable companies, the average price to AFFO is about 14.62, so if we apply that to ADC, their intrinsic value would be closer to about $63 per share, below that current share price. But this is where things get more interesting. Because they're growing faster, we should probably look at this valuation on a historical basis versus themselves. So we can look at the historical price to FFO valuation. Now what we're doing, we're just looking at the historical price to FFO over the past decade and comparing it to how it's currently trading. Now we can see at its peak around 6 years ago, it got as high as about 23.15, but it's come down quite a bit over the last few years. In fact, right now it's sitting at about 20.34. Now on average over the last decade, it's been about 18.14. So when you look at it compared to how it's historically traded, yes, it's still at a slight premium, but if you look at just the last few years, maybe since around 6 years ago, it's actually at one of the lower valuations that it's had. That's pretty interesting insight. Now, finally, if we look at them from a dividend discount model perspective, let's go ahead and zoom in a little bit more. What we can see is, assuming a dividend growth rate of about 3.75%, we'd come to an intrinsic value of $73.53, which is much closer to that current share price. And then the payout ratio, AFFO payout ratio, only about 72.5 to 72.6%, so those dividends are sustainable. So if we jump over to the output tab and look at these two valuations, we do come to an intrinsic value of $68.11. But again, this one's not a perfect valuation because they're growing faster than their peers. I think in this case, looking at it on a historical basis makes a lot more sense. And if you look at the past few years, they're trading at one of their lower valuations. So this is definitely a unique scenario when it comes to valuation. We have to remember valuation is much more of an art than a science. But if we still stick with these two valuations, we'd come to an intrinsic value of about $68.11. So with a 10% margin of safety, acceptable buy price of about $61.30. But with that being said, if we look at how the company's traded over the past year, there's been opportunities to buy within that 10% margin of safety. And this is one of the reasons I love to continually research these stocks, even if they look like they're trading at a 52-week high, because it lets you know when the opportunities will arise and you'll be ready for them. So again, when you look at all these different factors regarding Agree Realty, you can see why they've jumped up about 40% in the last year. But I want to be perfectly clear. There's pros and cons to Agree Realty and Realty Income. And for example, one of the things we can see when it comes to Agree Realty is they do have a lower credit rating than their peer Realty Income, something else to keep in mind. But go ahead and let me know what you think of Agree Realty in the comments down below if you plan on buying or selling, and like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.